So, John, tell me how you feel about risk.
I'm comfortable with it.
Yeah?
I'm good. Yeah. No, I really am.
So, you work pretty hard for your money. I mean,
I
ever
do.
since I've known you, right?
Yeah.
You've worked hard.
Nope, I do. I work hard. But part of that work is building a business from scratch, starting with 2 laptops and a card table and building it up to a regional law firm that covers, multiple states, advises people around the country, has multiple offices, multiple attorneys, dozens of staff people, all of which I've
Your own
done.
jet?
What's that?
Your own jet?
Yeah, not yet. But I've done all of that by taking risk after risk after risk, and hoping that my gamble would pay off.
Yeah.
And many of those were significant enough that if it failed, it would fail bad, like bankruptcy bad. So the idea when you talk about risk, particularly in the context of, say, a retirement portfolio, seeing it go down a little bit, meh.
Yeah.
It ain't going to go all the way down.
Yeah.
I'm good.
So living close to the edge is something that you're accustomed to.
Yeah, I would say so. I probably I may have a greater tolerance for it based on my experience than other folks.
Yeah. Because risk tolerance is interesting. Studies show that risk tolerance scores increase and decrease, and by that I mean how tolerant someone is to take on risk with their investments. They increase when the market is good, and they decrease when the market is not doing good. So, we're talking about the same individuals here, right?
Right.
You go into a bull market where everything's doing great, and they're willing to take on a lot more risk. And then as the market starts to decline, all of a sudden they're like, yeah, I don't know. I think I need to get more conservative in my portfolio. The reason is that most of them, unlike you, have never experienced a substantial amount of risk, maybe in their personal life or in their portfolio. And some of them have certainly never been through a market like we've been through that started back mid-February, where since then, as of the recording of this, we're down 32%, something like that. So, I mean, we've had a catastrophic decline in the market that's been very, very quick. And now all of a sudden, a lot of people are going, wait a minute, I didn't know it could get this bad. Despite the fact that on their risk tolerance survey, they said, yep, I'd be fine with that. And I understand it, right? People have never been through it. They don't know what it's going to feel like until they walk through it. And now that we're here, they're wanting to do something. Even if it's wrong, they're wanting to make a move. I've got to stop the bleeding. I can't handle this anymore, Devin. And I've been hearing some of this. So far,
Sure.
I will say that I haven't lost one client to the emotion of I've got to sell. Not one. I haven't seen one person say, get me out of my investments, put me in cash. I can't take this anymore. I would like to say that's because I'm very persuasive, but the truth is, over the years, I've just gotten rid of all my stupid clients. And if you're a former client watching this, I'm very sorry.
It wasn't you, not you specifically.
There
were others, but it wasn't you.
It absolutely was the others, yeah. So I get it that now that we're in this market, a lot of people are also looking at it saying, okay, when it comes back up, we're going to talk about risk. Now, maybe they went through 2008 and 2009, and they, much like me, thought that that'll be the worst market that will occur in their investing career. As investors, they would never have to go through another market like that because that was bad, right? That was the worst bear market since the Great Depression. And yet here we are again, going back through what looks like it could be the same thing. I mean, we're only, 10, 12 percentage points away from the low in the 2008 through 2009 bear market. So we got there really quick, too.
Right. Yeah, a couple of days.
So we could go through a whole conversation about, it got down quick, it's probably going to pop back quick, all of that. But that's not really where I'm wanting to go with this. What I want to talk about is making sure your portfolio is in a position to bounce back. Because I remember in that 2008 and 2009 market, not everyone popped back the same. Some people who had some garbage in their portfolio, who needed to do some cleanup, and didn't use that golden opportunity to do some of that cleanup. They just didn't come back as fast as some of those people who got their house in order and used the broom a little bit and got rid of some stuff. And that's what we need to do now. There's really 3 steps. The first is you just need to examine your current portfolio. You need to look at it. You need to make sure it's diversified and not just in a bunch of stuff. That's not the same as diversity. I've seen lots of portfolios come in, especially recently, where people have had accounts spread out all over. Sometimes it's even at one firm, and they'll have this long list of mutual funds or ETFs or whatever it is. And when you start looking at it and you really get under the hood, you realize that all that stuff's just buying the same investments.
Right. Yeah, it's 17 different mutual funds that all hold the same 3 stocks.
Right. And maybe that's an exaggerated example, certainly.
But you get the point, right?
Right.
I mean, yeah, that's the point.
Yeah. If you're buying, all of your funds are large cap stocks, then you have an incredible exposure to some of the technology stocks that are out there because that's what they are heavy in. But it can look on paper like you are diversified. So you need to make sure that you are properly and broadly diversified, first of all, period. The second thing is you need to make sure that you're not paying too much in fees and expenses. Talked to someone yesterday. They had a portfolio. It was a smaller part of their overall portfolio, but it was in an annuity, which we need to do an episode where we talk about annuities and we lay out those fees and expenses.
Absolutely. You're right. We need to cover that.
Yeah, needs to happen. They were paying right at 4%.
Ooh.
And when I explained to them that, listen, here's the way this 4% works. Not only does it keep you from making money in all these years past when the market's been great, now that the market's going down, it's acting like the brick tied onto your ankle. And it's just pulling you down further because they're getting those fees and expenses. And the crazy thing is, in some of those annuities, I can feel myself going off on the rabbit trail here. So you're going to have to pull me back in a minute.
All right.
With some of those annuities, there's this little separate value that they use. It's the income base, or there's a number of other things they call it. And sometimes those fees and expenses are based on that amount. And that amount doesn't change with the market. So as the market's declining, they're still getting their fees off of the higher amount.
Mm-hmm.
Which means that as a percentage, if you were paying 4% after the market drops like it has, you may be paying closer to 5%. Heaven forbid any more than that. But when you're going through your portfolio, you're making sure you're diversified, you're getting rid of all of the expensive stuff, you're not paying more than you need to for either your investments that's in the portfolio or the service that's coming to you from your advisor. It's 2 separate fees and expenses. You got to understand that. Both of those are expenses you need to make sure you're not overpaying for. And once you do that, then it's time to make changes if they're needed. Get some professional help if you need to figure out what changes you need to make.
That's right. Get it diversified, get it balanced, and then make those changes. Right?
Yeah.
Do it.
Yeah.
And then actually do it.
There's enough people out there that can help you
Sure.
figure this out on an hourly basis too. You don't have to turn over your investments to someone just to get them to look at it. There's a lot of people, that's what they want to do, but there's people that will help you for an hourly fee to make sure that your portfolio is set up. They have some tools that can plug all of your stuff in and then give you some reports based on what your total diversity and fee structure really looks like. And I think everyone ought to use some of that. And then there's the free version. Well, it's not free, but I think it's $100 and something per year, so it's relatively inexpensive, that Morningstar has that you can sign up. Morningstar Premium, Morningstar Premier, I don't know what it's called. But it's the Morningstar tool that's paid, that's for investor use. And they have that X-ray feature in theirs that's really interesting. Put all your holdings there, and it'll show you the diversity, and it'll also show you the total fee structure of your entire portfolio. So if you have investments held over here, over here, over here, and over here, you can still plug it all in there, and you can figure out how much you're paying for the investments. It doesn't say what you're paying for your fee structure to your advisor,
Right.
but it does for the investments that's in there. So once you figured all that out and you say, okay, I need to make some changes, make the changes. Don't sit there and keep waiting and wondering and guessing. Should you make the changes? Make the changes. Get it diversified, get it spread out, and then once you make those changes, walk away.
Yep. Don't look at it.
Yep. Focus on what you can control. And that's, you can control how broadly allocated you are. You can control the fees you pay. You can control your emotions. You can control the amount you invest or the amount you pull out for income. You cannot control the market. You cannot control tax policy. You can't control how they approach the virus that's currently spreading the nation, whether they want to ignore it or shut the entire nation down. You cannot control all that. But you can control what's in your portfolio. You can control that diversity that's in there, that fee structure in there. And right now, I'm telling you, a lot of investors are in a golden opportunity to make changes in their portfolio where they're going to have a stronger bounce back than some of their peers.